It's a very, very big week given the Fed gathering that's going to happen out in Jackson Hole and where market expectations are in terms of rate cuts and how investors have positioned themselves. Let's talk more about that with Solis Alternative Asset Management's Dan Greenhouse, New York Life's Lauren Goodwin, and Capital Area Planning Group's Malcolm Ethridge. It's great to have everybody with us. We'll turn, Dan, our attention from the White House to Wall Street, where we do have all of this anticipation now about what could be said at the end of the week. Are we in wait-and-see mode until we actually hear from Chair Powell?
I don't think there's any doubt that we're in wait-and-see mode. There are two obviously strong competing views about what the Fed is likely to do, what the Fed should do, what the Fed could do, what the president should or could do in response to what the Fed should or could do. So I think market participants are pretty divided, and so I think we're definitely in a wait-and-see mood. My own personal view is that I think the bias is still for them to reduce rates by 25 basis points at the September meeting, but I certainly think 50 basis points, which was always a really unlikely outcome, is now basically dead in the water. And the question is, how does the chairman frame the debate that's currently being had both inside and outside the Federal Reserve?
Malcolm, how do you see the events of this week and their importance to where this market goes from here?
Yeah, I think to Dan's point about 25 basis points now versus potentially 50, if you're a stock market investor, the Jackson Hole conversation, even if it results in a September cut, doesn't really matter for you nearly as much as the AI conversation we've been having for the last year and change, right? So as long as you have the likes of Microsoft, Alphabet, Amazon, and Meta scheduled to spend a collective $350 billion on investing in AI infrastructure just this year alone, that is the story, the narrative that's carrying the market. So a couple of interest rate cuts aren't really going to matter for those companies or any of the other hyperscalers who don't have to borrow to make those investments. They can cash flow it themselves if they choose to. And so I think Jackson Hole will be important. I think a September cut versus later this year will be important. But for stock market investors specifically, it really isn't going to move the markets.
Lauren, what are your thoughts? I mean, I thought it's interesting that we still have a considerable debate from the Wall Street houses, if you will, on what the Fed's going to do over the remainder of the year and into next. Goldman's sticking with 3 cuts this year and 2 next. Other firms are saying none this year. There was one other that said, well, we'll get 1. Does any of that matter for where stocks would go between now and the remainder of the year?
I think it does matter because the market has really coalesced around the idea that no matter what the pace of rate cuts, the Fed is in a prolonged cutting cycle. I think the challenging reality for that narrative is that I'm on the side of the fence that says the data, though we have some evidence that cutting could make sense in the near term, it's not a clear-cut case for the Fed. And the points that Malcolm's making around AI investment, the reality of the broader sense of policy uncertainty that's making its way through the market over the remainder of the year, those are contributing to that case that not only are the economic conditions not necessarily requiring a cut, but financial conditions aren't necessarily requiring a cut. And so I think the narrative that the Fed is moving towards cutting over some timeline is the most important piece. Exactly when and how frequently isn't as important right now.
Dan, I like Malcolm's perspective on this, that essentially what's happening all around us is noise in the face of what is an undeniable and long-lasting trend of AI and this transformative impact that it's having not only on these companies, on these markets, the way we're all going to think about living, working, investing in the years ahead. Goldman's Tony Pasquarello today says, one specific point to underline here is my long-standing bias for large cap over small cap. There's good reason to still believe in the fundamental underpinnings of that trend.
I agree with a lot of what Malcolm had to say. And the sentiment, again, to repeat, is just you've got this secular theme that is driving the market. And for the 100th time, Malcolm's made the point, I've made the point, Dan Ives has made the point. This goes beyond NVIDIA and Broadcom. It goes down to Amphenol and GE Vernova and Vistra and Vertiv and Eaton and Trane Technologies and all the other parts of the S&P 500 industrials, utilities that are benefiting from this secular trade. And if we think about this, and I've talked about this a bunch, I know Dan Ives, who's coming up later, has as well. If you think about this through the late 90s, The number of times people told you in the late 90s, subsequent to the Netscape IPO, the number of people wrote about and discussed market valuations being excessive, and it's a bubble that was forming, et cetera, was innumerate over those 5 years. And it wasn't until, and this is the most important point, it wasn't until 2000 when you had the DOJ stepping in to prevent some additional mergers, which had been a huge driver of the gains, and profit warnings from Intel, from Lucent, from Sun Micro, et cetera. We're nowhere near even really a slowdown in cloud growth, let alone profit warnings. And I really think more, to Malcolm's point, as long as that trend is in place, yeah, the Fed matters. Lauren's right. As long as you're skating towards lower rates, that's a positive. But that theme is playing itself out and is unimpeded at the moment.
I thought, Malcolm, that was part of Rick Reeder's point last week that he made on this program, that you can have a problem with valuation of those AI stocks. But when you look at the degree in which they're growing their earnings and they are at the forefront of what's truly happening, and it doesn't look to be slowing down anytime soon, if you pair that with the idea that, well, the Fed is going to be cutting rates at some point, it may not be on the calendar that certain people think, want, or expect, but there are enough things that you can put 1 + 1 + 1 + 1 equals a pretty darn good outcome for these markets.
Well, the last two earnings periods have made that case too, right, Scott? So we had the questions last year of, have the hyperscalers gone too much too soon? Have they invested too many dollars? Are they committed to too much CapEx? And that started to weigh on that growth narrative. And then this year, so far, the first 2 quarters, you had the likes of Microsoft, for example, or NVIDIA, who showed up with bang-out numbers once again, proving that there really is still demand and not enough supply for all of these different critical components, to Dan's point, of the AI infrastructure and the AI arms race. That's proving in real time. It's not a thing that we have to wait 3, 5, 10 years to see how are these investments going to pay off. Meta's already delivering results each time they come to us with earnings, and so they are defying gravity from a earnings multiple perspective. But I think they're also earning a little bit of headway, and that is really the narrative that I think stock market investors, again, should be paying attention to. If you're a bond fund manager, obviously every quarter point matters to you. But realistically, unless we're talking about more than a 50 basis point cut at any of these 2 or 3 Fed meetings that we're expected to have before the year is over, and that's what's supposed to drive the cutting pattern, unless they're massive cuts, I just don't think that it's really going to be enough to rock the confidence of any stock market investor who's really been paying attention.
Lauren, do you think the broadening trade, so to speak, is the biggest wild card this week?
I want to pick up on one of the elements of Malcolm's argument, which is that we've been talking a lot about equity investors, but a lot of the news this week is impacting other asset classes as well. And I think this is a component of an asset allocator's challenge right now that's really, really important. Mentioned a little bit with respect to Jackson Hole this week and the Fed, that 25 basis points now or in a couple of months probably doesn't make a ton of difference. But that promise, let's say, or assurance of some sort of cutting cycle is even more important in the face of the broad range of policy uncertainty that we're seeing. I mean, we're talking earlier in the program about war, energy security, defense, geopolitics. These are all elements of the policy backdrop that are impacting and have caused a major freeze up in asset classes like private equity and that private equity, private credit landscape. And so moving towards a direction where the Fed could be signaling a little bit of easing actually contributes back to the public equity markets by unlocking some capital out of other elements of the public and private markets.
Guys, we'll leave it there. Appreciate it very much.